Imagine you wake up and find a flyer in your mailbox. It promises a guaranteed 8% return on your money every single year. No work, no effort, just pure mailbox money. You look at your savings account, which is currently earning next to nothing, and you think, this is it. This is the financial perpetual motion machine I have been waiting for. You move your life savings into this asset. The checks start coming in. $800 a month on a $100,000 investment. You feel like a genius. But then you look at your account statement. Your $100,000 is now worth $85,000. A year later, it is $70,000. You are collecting 8% in income while your principal is bleeding out by 15% a year. You are not getting rich. You are watching a slow-motion car crash in your own brokerage account. This is the Dividend Lie 2.0. It is the modern version of a classic trap, and it is quietly destroying the retirements of thousands of well-meaning investors who think they are being conservative. Today, I want to show you why that 8% yield is actually a massive red flag that a business is dying, and how you can spot the difference between a golden egg and a ticking time bomb. Before we dive into the math that the big banks do not want you to focus on, I want to make a deal with you. The next 20 minutes might be the highest ROI you get on your time this entire year. We are going to peel back the layers of corporate accounting to see why companies that look like bargains are actually burning down. If you find value in this kind of deep dive financial literacy, go ahead and hit that subscribe button. It is the best way to tell the algorithm that you prefer actual data over hype. I have spent hundreds of hours digging through Morningstar reports and academic papers, so you do not have to. My goal is simple. I want you to stop being the liquidity for institutional investors who are desperate to offload their failing positions. We are going to look at why yield chasing is the most expensive mistake a retiree can make. If you are ready to see the numbers that the flashy dividend gurus ignore, let us get to work. We are starting with the basic mechanics of how a yield is actually born, and why it is often an accident, not a choice. To understand why an 8% yield is usually a siren song leading your portfolio toward a shipwreck, we have to look at the basic math. Dividend yield is a simple fraction. You take the annual dividend per share and divide it by the price per share. It sounds straightforward, right? But here is the catch. That yield is dynamic. It is not a fixed interest rate like a bond. It changes every single second that the stock market is open. A yield can go up for two reasons. The first reason is the one we all dream of. The company is growing, profits are soaring, and the board of directors decides to give you a raise. That is a healthy increase in the numerator. But the second reason a yield spikes is much more common in the world of high yielders. The denominator decreases. In plain English, the stock price plummets. When you see a stock yielding 8, 10, or 12% in a market where the average yield is closer to 1.5%, it is almost never because management is being generous. It is because the broader market has lost faith in the company. Institutional investors, the guys with the PhDs and the supercomputers, have already seen the writing on the wall. They have sold the stock, driving the price down and mathematically forcing the yield up. That high yield is not a gift. It is a warning sign that the business is in a state of collapse. There is a fundamental concept in finance called the Modigliani-Miller theorem, and it is something every investor should have tattooed on their brain. It states that, in a perfect market, dividends are irrelevant to the value of a company. Think about what actually happens on the ex-dividend date. When a company pays you a dividend, that cash does not manifest out of thin air. It comes directly off the company's balance sheet. If a stock is trading at $100 and it pays a $1 dividend, the exchange literally adjusts the stock price down to $99 the next morning. You have not gained any wealth, you just have $99 in stock and $1 in cash that you now have to pay taxes on. This is where the Dividend Lie 2.0 starts to hurt. When a struggling company insists on maintaining a massive dividend payout despite a falling stock price, they are essentially bleeding themselves dry. They are taking cash that should be used to pay down debt, reinvest in technology, or pivot their business model, and they are handing it back to you. It is like a captain of a sinking ship handing out gold coins to the passengers instead of using that gold to plug the hole in the hull. It feels good in the moment, but the end result is still the bottom of the ocean. According to research from Morningstar, an exceptionally high yield is often the market's way of pricing in an impending dividend cut. The market is efficient, even if we don't want to believe it. If a company is yielding 8% while its peers are yielding 4%, the market is telling you that the dividend is not safe. The high yield is the risk premium you are being offered to hold a decaying asset. Think of it like this. If you saw a used car for sale at half the price of every other car of the same model, you wouldn't think you found a bargain. You would assume the transmission is about to fall out. High-yield stocks are the fixer-uppers of the stock market, but without the upside. When a company's price drops significantly, it's often because the collective wisdom of the market has determined that future cash flows are impaired. The dividend yield looks huge because the price has crashed, but that dividend is usually the next thing to go. By the time the board of directors actually announces the cut, the stock price has often already dropped 50%. You get hit twice. Your income disappears and your principal is gone. It is a mathematical artifact of a business that is losing its grip on reality. If you think the math of a falling stock price is bad, wait until you see what happens behind the scenes in the boardroom of these companies. We are about to look at the anatomy of a dying business, and it is not pretty. Most people think a company pays a dividend because they have extra cash. In the world of 8% yields, that is often a total fabrication. I have seen companies take out high-interest loans just to pay a dividend so they do not scare off their last remaining shareholders. It is corporate life support, and the cost of that support is your long-term wealth. Before we get into the 3 specific red flags you need to look for, remember that management's primary goal is often to keep their jobs, not to protect your principal. They will burn the furniture to keep the house warm for one more winter. We are going to look at why some industries are structurally designed to fail, and why your high-yield hero might just be a king of yesterday's economy. This is where the dividend dream turns into a fundamental nightmare. Why do companies end up in this high-yield purgatory? It usually starts with structural decline. Most companies paying yields over 8% are the kings of yesterday's economy. I am talking about legacy telecom providers, dying print media, mall-based retailers, or obsolete hardware manufacturers. These are businesses whose primary models are being actively disrupted. They can no longer promise investors growth, so they try to bribe them with dividends. It is a form of financial desperation. Management knows that if they stop paying that outsized dividend, the last of the institutional investors will dump the stock, and the price will go to zero. So, they become what we call a bond proxy. They try to act like a safe bond, but they have none of the protections. Unlike a bond, where you are legally owed your principal back at maturity, a stock has no floor. You are taking on equity risk for a fixed income return. It is the worst of both worlds. You get the volatility of a tech stock with the upside of a savings account. When an industry is shrinking, the companies within it are often just liquidating themselves in slow motion. That 8% yield isn't profit. It's just a refund of your own capital while the business shrinks around you. If you want to know if a dividend is safe, you have to look at the payout ratio. This is the single most important metric for any income investor. It is the ratio of the total dividends paid out relative to the company's net income, or, more accurately, their free cash flow. A healthy, mature business usually keeps its payout ratio between 40 and 60%. This gives them a massive margin of safety. If a recession hits or sales dip, they can still pay the dividend and have money left over to keep the lights on. But when you look at these 8% yielders, you often find payout ratios of 90, 100, or even 150%. Think about the insanity of that for a second. A payout ratio over 100% means the company is paying out more money than it is actually earning. How do they do that? They don't have a magic money tree. They do it by taking on new debt or selling off their core assets. It is the corporate equivalent of taking out a cash advance on a high-interest credit card just to pay your mortgage. It is mathematically unsustainable. Eventually, the bank stops calling and starts acting. When the debt load becomes too heavy, the dividend is the first thing they cut to save the company from bankruptcy. By then, the stock price is already in the basement. High yielders are notoriously debt-heavy. For the last decade, when interest rates were near zero, these companies could afford to carry massive debt loads. They could borrow money for next to nothing and use it to keep their dividends afloat. But the world has changed. As interest rates rise, the cost of servicing that debt skyrockets. When these companies have to refinance their old bonds at today's higher rates, their free cash flow gets obliterated. The Wall Street Journal has done extensive reporting on this corporate debt crisis. Management eventually gets backed into a corner. They have two choices: default on the debt, which wipes out the shareholders completely, or slash the dividend to zero to satisfy the bondholders. They will always choose the bondholders. In the capital structure, you, the equity holder, are at the very bottom. You are the last person to get paid and the first person to get cut. When you see a high yield combined with a massive debt-to-equity ratio, you are looking at a time bomb. It is not a matter of if the dividend will be cut, but when. And usually, the when happens exactly when you need the money the most, during a market downturn. You are essentially gambling that interest rates will stay low forever just to collect a few extra percentage points of yield. If these stocks are so dangerous, why do millions of retail investors still flock to them? The answer is not found in a spreadsheet, it is found in our brains. Humans are prone to a cognitive bias called mental accounting, a concept pioneered by Richard Thaler. We tend to put our money into different mental buckets. We have the capital bucket, which is the stock price, and the income bucket, which is the dividend check. Retirees are especially susceptible to this. They tell themselves that as long as they don't sell their shares, they haven't actually lost any money. They can watch the stock price drop 50%, but as long as that quarterly check hits their account, they feel secure. This is the income illusion. It is the belief that the dividend is somehow separate from the value of the company. But as we have established, the dividend is literally just a piece of the company being handed back to you. If your $100,000 investment drops to $60,000, but you collected $8,000 in dividends, you are still down $32,000 in total wealth. Your brain is tricking you into feeling successful while your net worth is evaporating. You are focusing on the golden egg while the goose is being slowly roasted. We are about to look at some real-world case studies of massive companies that trapped investors with this exact psychology. But first, if you want to take your financial literacy to the next level, I want to invite you to join the Optimizers. By clicking the Join button below, you become a member of a dedicated group of investors who get priority comment replies and custom badges to show your status in the community. It is a small way to support the channel and ensure we can keep doing these deep, research-heavy dives without having to rely on corporate sponsors. I spend a lot of time in the members-only area answering specific questions about the data we cover. If you are serious about protecting your principal and building a portfolio based on math rather than hope, we would love to have you. Now, let us look at the graveyard of high-yield stocks, starting with a name everyone knows, AT&T. For decades, AT&T was the ultimate blue-chip stock. It was the one stock that every grandmother owned because it was considered as safe as a government bond. But in the 2010s, things changed. AT&T went on a debt-fueled spending spree, buying DirecTV and Time Warner. They were trying to buy growth because their core telecom business was stagnating. By 2020, they had accumulated more debt than almost any other non-financial company on Earth. As the stock price languished, the dividend yield spiked to over 7%. Yield chasers saw this as a once-in-a-lifetime opportunity. They thought they were buying a massive telecom giant at a bargain. They ignored the debt and the structural decline of satellite TV. In 2021, the reality hit. AT&T announced they were spinning off their media assets and, more importantly, cutting their dividend by nearly half. The stock price tanked. Investors who bought for the 7% yield suffered a brutal double whammy. Their income was cut in half and their principal was decimated. This is the textbook example of Dividend Lie 2.0. The high yield wasn't a sign of value, it was a beacon of distress. The market knew the debt was unsustainable long before the retail investors did. If you followed the math of the payout ratio and debt to equity, you saw this coming miles away. But if you only looked at the yield, you walked right into the trap. General Electric is another haunting example. This was a company that was a founding member of the Dow Jones. It was a dividend powerhouse. But after the financial crisis, GE's massive financial arm began to crumble. As the stock price slipped, the yield spiked, attracting income-hungry investors who thought GE was too big to fail. They were wrong. GE's core industrial businesses were struggling, and they were using accounting tricks to mask the rot. The payout ratio became a joke. GE was forced to cut its dividend in 2009, again in 2017, and then in 2018, they famously slashed it to a single penny per share. Investors who held on, chasing that high yield on the way down, lost over 80% of their principal. A high yield on a legacy industrial giant did not offer any protection. In fact, it acted as a distraction. It kept people focused on the penny dividends while their life savings were being incinerated. This is why I say you can't just get paid to wait. If you are waiting in a burning building, the fact that someone is handing you $1 every 10 minutes doesn't make it a good place to stay. You have to look at the underlying structure of the business. To break free from the dividend lie, you need a paradigm shift. You have to stop looking at yield and start looking at total return. Total return is a simple calculation. It is your capital appreciation plus your dividends. That is it. That is the only number that matters for your wealth. Why? Because your grocer and your utility company do not care where your money comes from. $1 from a dividend is worth exactly the same as $1 from selling a piece of an appreciated stock. Vanguard has published extensive research on why a total return approach is superior, especially for retirees. When you focus only on yield, you are forced into poor quality companies. When you focus on total return, you can own the best companies in the world. Think about it. Would you rather have a stock that pays an 8% dividend but drops 5% in price every year, or a stock that pays a 2% dividend but grows by 8% in price every year? In the first scenario, your total return is 3%. In the second, it is 10%. Over a decade, that difference is the difference between a comfortable retirement and running out of money. Total return is the ultimate arbiter of truth in the market. We also have to talk about the hidden cost of yield chasing, the tax drag. If you hold these high-yield stocks in a taxable brokerage account, you are creating a forced tax event every single quarter. Every time that company pays you a dividend, the IRS takes a cut, up to 20% for qualified dividends and even more for things like REITs. This significantly slows down the compounding of your wealth. In a total return strategy, you have much more control. If a company doesn't pay a high dividend, but instead reinvests that cash or buys back shares, the stock price goes up, but you don't owe a dime in taxes until you choose to sell. You are essentially letting your money compound tax deferred. Harvard Business Review has noted that intelligent capital allocation, management choosing buybacks and reinvestment over bloated dividends, is historically a much better driver of long-term value. By chasing high yields, you are essentially asking the company to force you to pay taxes today, rather than letting your wealth grow and paying taxes on your own terms later. It is a massive inefficiency that most dividend gurus never mention. When you factor in the tax drag, that 8% yield often looks more like 5 or 6%, while your principal remains at high risk. So, how do you protect yourself? You need a strict fundamental stress test. Step 1 is the free cash flow audit. Do not ever rely on the standard earnings per share payout ratio. Accounting earnings can be manipulated. They include non-cash charges like depreciation that don't actually reflect how much cash is in the bank. Dividends, however, are paid in cold, hard cash. You need to look up a company's free cash flow per share and compare it to the dividend per share. If the company is paying out more in dividends than they are generating in free cash, they are bleeding. It doesn't matter what the CEO says on the earnings call, the math says they are in trouble. Walk away immediately. Step 2 is checking the interest coverage ratio. Take the company's earnings before interest and taxes and divide it by their interest expense. If that number is below 3, they are struggling to even pay the interest on their debt. In a high interest rate environment, that dividend is a luxury they cannot afford. By running these two simple checks, you will filter out 90% of the dividend traps in the market. You are looking for businesses that pay you out of their abundance, not out of their desperation. The financial markets are ruthlessly efficient. In a world where you can get 5% from a safe government bond, an 8% yield on a stock is never a free lunch. It is a blinking red light telling you that the market has lost faith. The Dividend Lie 2.0 preys on our desire for passive income and our fear of selling assets. But a dividend check is worthless if the principal generating it is rotting away. True wealth isn't generated by chasing the highest yield, it is generated by compounding quality over time. I want to hear from you in the comments. Have you ever been caught in a yield trap? What was the stock that taught you this lesson? Your experiences act as a peer review for the rest of this community, and I read every single one. If you found this helpful, share it with one person who you know is currently chasing yields. You might just save their retirement. I am Tom, and this is Tom Talks Money. Focus on the total return, protect your principal, and I will see you in the next one.